First of all, I'd like to thank Davina and the Nefesh B'Nefesh team on arranging this series and this class. And I want to thank Nefesh for all the work they're doing with Olim, helping Olim pre-Aliyah with the Aliyah process and post-Aliyah. They're doing an amazing job. I want to thank them. We are working with Nefesh B'Nefesh for a few decades already, and it's always a pleasure to join their events and their classes that they give over. So thank you. Okay, so today we're gonna discuss investing in Israel and investing in general with a focus on the investing and investment options in Israel. So today was this class was meant to be given over by Baruch Levinsky, the CEO of Levinsky Financial, but unfortunately he's not feeling well, so I replaced him. Baruch is the founder and CEO of Levinsky Financial. We have experience in financial advising and investment managing with Olim for over 30 years. Today's topic is going to be financial investing in Israel, and we're going to go over a few different topics, including asset management, which is part of our services that we give. We also give over financial consultations. We introduce clients to alternative investments and help with Aliyah planning. This is just the overview of our services at Levinsky Financial. So we will give some time for questions. We're going to stop every 20 minutes or so to answer some questions. So if you have any questions, just put them in the chat and we will address them. So what is on our agenda? We're going to go over the general idea of investing. Why would someone want to invest? We're going to go over the basics of investing, give you some background to the world of investing, and we will dive into the Israeli capital markets, which will be our main focus today. The Israeli capital markets and the investing in Israel versus investing abroad in the US and in other markets. We're going to discuss some tax issues that are relevant in Israel and specifically to Olim, and as well some due diligence checklist that one should do before deciding on any investments. And we will also explore the different options of doing it yourself, the pros and cons of doing it yourself versus using a professional. Okay, so just a general background or introduction to investing. So why would someone want to invest? Why not just put money aside and save it for whatever reason you're saving the money for? You could save money for retirement, for a big expense, for buying a house, for helping your kids with education, with weddings. People save money for many different causes. Then the question is, why would someone want to invest the money rather than just saving it and putting it in the bank? So there are a few reasons why you would want to invest your money rather than just saving the money. One reason is inflation. So what is inflation? Inflation is the cost of living. Cost of living goes up. That is a regular the regular way that the economy works. Prices of goods go up, and therefore our cost of living goes up. So that means whatever you can buy with today, if you have 100,000 shekels today, whatever the buying power of that 100,000 shekels in 10 years from now will buy you much less. So inflation basically eats up the buying power of your money, and you want to at least keep up with the inflation rate so that your money doesn't, the buying power of your money doesn't fall behind. So that is one reason why you want to invest. In addition to just keeping up with inflation or even managing to beat inflation, you would want to invest your money because by investing, you could end up with more money at the end of the term. So the money is working for you and growing if you invest it properly. And then you end up not with just the money that you have saved, but with a lot more money if done properly. So these are the two main reasons why you would want to invest your money rather than just saving the money. Now, the power of investing over time is tremendous. We call that the power of compounding. Okay, I will also, for those who are not familiar yet with Hebrew, I will also translate some of the terms to Hebrew. So you know how to say it in Hebrew. So the power of compounding or compounding interest is ribit de ribit. It's interest on interest, which means that the money that is growing, the investment that is growing, is also growing. The returns are also making more returns. And that power compounds over time and ends up making a lot more money in the long term. So that power was described by Albert Einstein as the eighth wonder of the world, the power of compounding. So let's just give a few examples of compounding and see how powerful this tool can be over time. Okay, so in this chart, you can see what $10,000 investment of $10,000 could earn for you over time, over different periods of time, at different interest rates or returns, levels of return. So on the left side, you can see the years, the number of years of the investment, from 5 to 10 to 15, all the way to 35. And then on the top is the average rate of return that one managed to achieve from his investment. So starting from 2% rate of return, that is a very low rate of return. We mentioned before the inflation. So the average inflation over the long term, the cost of living goes up each year by around 2%. That's like the long-term average. Right now, the past couple of years, it's been much more than that, but that is the long-term average of inflation. So 2%, to make 2% is very low. You would usually get 2% from a short-term bank deposit. Right now, even that is higher than 2%, but that is a really low rate of return. So if someone invested his money at very, very low risk and made 2% annual rate of return, you can see that after 35 years, the same $10,000 without adding any money turned from $10,000 to almost $20,000. So the money doubled in 35 years at a 2% annual rate of return. Now let's see what happens if someone invests the same $10,000, but instead of making 2%, they manage to make 4% a year. So what happens then? 4% a year, you can make nowadays that interest rates are high. You could make 4% from a bank deposit if you lock it up for a certain period, usually a year or so, or from short-term bonds. 4% is a conservative uh, return that you can make from low-risk investments right now. So at 4%, you can see that the $10,000 from turned from 10,000 into 39,461 after 35 years, which is also a very nice return, and the money almost quadrupled. So that is if you manage to get 4% a year. And as you go on, let's just jump a second to 10% rate of return. Okay, so 10% rate of return is already considered to be a high return. It is something that's achievable. The average return from the S&P 500, which is the US stock market index. We will discuss that further later on. But the average US stock market return in the past few decades was somewhere around 9 to 10%. So if someone managed to achieve a 10% rate of return each year, that $10,000 that one invested turned into $281,000 after 35 years. Okay, and if someone manages to make 12% or 4%, that's already a different level, but those rates of return are very high and come with a lot of risk. So I don't know how realistic that is, but this table just shows you the power of compounding, how over time, the power of the compounding, the returns are making more returns and they're making more returns over time, how that results in tremendous profits. So the time over here is a very important player. And also the rate of return, if you manage to achieve a higher rate of return, if you do it, of course, in a smart way, without taking too much risk, and we will discuss that as well later on, you can see how by investing it in the right way and achieving a nice rate of return, how that could make a huge difference. If we just look at the 10% rate of return compared to the 8% rate of return, after 35 years, the 8% made the $10,000 turned into $147,000. And the 10% rate of return, which is only 2% more each year, doesn't look like a big difference, but in fact, it made $281,000, almost double, just by making 2% more each year. So this is the power of compounding. Another example of the power of compounding, in this chart, you can see what happens if someone gifts their child or their grandchild $1,000 when they were born, and they invest it for them. So you can see over here, also on the left-hand side, you see that is the gift value over time. And on the top, you can see that is their age and at different rates of return. So on the left, you can see it's a 2% rate of return. So $1,000 at age 72 would turn into $4,000. And if you go to the 8% rate of return, you can see that $1,000, only $1,000 that you invested for your child or for your grandchild at age 63 would turn into $128,000. That's at an 8% annual rate of return. And if you manage to make 10% a year, that same $1,000 at age 64.8, almost 65 years, that turned into $512,000, over $500,000. $1,000 at a 10% annual rate of return turned into over $500,000 at age 65. So this is an example how powerful the power of compounding over time. You let it grow, you start early and let it grow over time at a good rate of return, and the results are phenomenal. Okay, one more example over here. In this example, you can see what happens to someone who started investing at age 19 and started putting aside $2,000 each year for 8 years. So from age 19 till age 27, they put aside $2,000 for a total of $16,000. Okay, so that person, that student, that young person at age 19, whatever they're doing, they managed to save $2,000 a year for 8 years and invested it at 10% rate of return. Those $16,000 turned at age 65 into $1 million. So just saving $16,000, $2,000 per year at age 65 turned from $16,000 into $1 million. Now let's take a second example. Someone else did the same thing, but instead of starting at age 19, they started at age 24, just 5 years later. 5 years later, they started saving $2,000 each year. How long would they need to continue investing $2,000 a year until they get to $1 million at age 65? So the answer will shock you, but that person number 2, started investing and putting aside $2,000 a year at age 24, will need to put $2,000 aside for 41 years in order to get to $1 million at age 65. At the same 10% rate of return, they will need to put aside a total of $82,000 so that they will get to $1 million at age 65. Just the difference of 5 years, because those 5 years at the end, when you have a lot more money that grew over the years, quadruples and compounds much more than the earlier years. So although he started only 5 years early, but he gained 5 more years of growth at the end. So starting early makes a very big difference, and this is a great example why it's so important to start early. Okay, so this is the power of compounding is another main reason besides keeping up with inflation why you would want to invest your money so that it could work for you and grow and compound over time and earn you great returns. Okay, the next point is creating an investment plan. Okay, so there are different types of investments. One very popular investment option is real estate. People love investing in real estate, especially in Israel. Real estate in Israel is very popular. This is not the topic of today's lecture. We're going to focus more on the financial assets. Okay, so one option of investing is in real estate, and financial assets is the second option that we will discuss today. Okay, so when we talk about financial assets, what do we mean? So financial assets is a general name for for assets that are usually publicly traded, which means that you can buy these investments through a stock exchange. So it's offered to the public. Anyone could go on a stock exchange and buy those financial assets. Now, there are two main asset classes in the capital markets, in the publicly traded securities. There are two types of securities, two types of asset classes. One is a stock, which is an ownership of a company. It's also known as shares or equity. So a person can buy a stock and he becomes an owner of a company or a very small owner of a company. Companies usually have millions and millions of stocks. So by buying a stock, you become an owner of one share of the company. And then if the company does well and they continue growing and their profits grow and everyone knows because they need to publicize their financial statements every quarter so everyone sees how the company is doing, then the price of the stock goes up over time. So that is one asset class, which is the stocks. The second type is what's called a bond. A bond in Hebrew, a bond is a igeret chov, okay, and a stock is a menaya or menayot. So what is an igeret chov, a bond? A bond is basically a loan that the person who buys the bond, the investor who's buying the bond, is given to whoever issued the bond. So bonds could be issued by a company, they can be issued by a government, and when you buy a bond, the company is basically committing to give you back the principal at a certain date based on the terms of the bond, and they pay you back interest. Now, bonds in general are considered to be more conservative, lower risk than stocks. And stocks are higher risk, but over time, stocks average higher returns than bonds. But that also comes with higher volatility. So stocks go up and down more over time, they fluctuate more, and bonds fluctuate less. So when the markets are doing well and everything is going up, then usually stocks will go up more than bonds. But when the market is not doing well and the market is going down, then the stocks will go down more than bonds. Okay, now let's just talk a little bit about why investing is important for you. Because some people could say, look, I don't have any investment portfolio. I don't invest any money in the capital markets. Why do I need to know about investing? Why should I educate myself on this topic? So the truth is that we are all invested in the market in one way or another. Even if you're not doing it actively yourself, going buying or have a managed portfolio, you still are invested and exposed to the stock market. So in Israel, there are a number of products that are mandatory. Some of them are mandatory, some are not, but a number of products that are part of the employment benefits or employee benefits that one has in Israel. And those products are invested in the stock market. So one product is a pension. The pensions are not mentioned here, but you learned about it already. I think you had already a class that went over pensions. So you should know what pensions are. But the pensions that is part of the Israeli Israeli payslip that around 20, a little over 20% or 20.5% of your salary goes into your pension. Most of it comes from your employer. Some of it comes from your salary. So that goes into the pension fund, and then the fund managers take that money and invest it in stocks and in bonds. So that is a very big part of your money that's going each month into the market. And that will be your foundation for retirement. So you want to know where your money is invested, or at least make sure that it's invested in the right place. So that is one major way that we are exposed to the stock market or the financial assets in Israel. Another way in Israel, another product that is also invested in the market, there is something that's called a Keren Hishtalmut. A Keren Hishtalmut is a fund, it's a savings plan that is offered generally by employers. It's not mandatory, but it's very common in certain industries, like the high-tech industry and the public sector and many other industries. It's offered by the employer. It's a savings plan that 10% of the salary goes into this Keren Hishtalmut. 7%, 7.5% comes from the employer. That's on top of your salary. And then 2.5% from the employee. So 10% of your salary goes into this investment product, and it's invested in a similar way to the pension funds, invested in the stock market and bonds, and that grows over time. Pay management fees to the manager, and after 6 years, this Keren Hishtalmut becomes available. So you can't use it for 6 years, but then after 6 years, you can take it out whenever you want. Now, this Keren Hishtalmut has major tax benefits. So you don't pay taxes on the deposits of the employer. The employer is basically adding 7.5% on top of your salary to into the Keren Hishtalmut. So up to a certain threshold of 1,000. Right now it's at 1,571 shekels a month. Up to that threshold, you don't pay any taxes on the deposits of the employer, and you also don't pay taxes, capital gain taxes, when you take out the money after 6 years or even after if you leave it for longer. So this is a major advantage. It's probably the best investment option that you have available in Israel. Also, self-employed could open a Keren Hishtalmut, and they can also deposit money and gain from these tax benefits up to the threshold. So this is another product that is invested in the market, and many workers in Israel have this product. Now, these products, also the pension and the Hishtalmut, have different investment tracks that you can choose which investment track it will be invested in. And that is a decision that you can make, which can make a very big impact on how it will do over time. So you want to be familiar and educate yourself so you can make a good decision. Okay, some other products that are available in Israel. Kupat Gemel. Kupat Gemel is a general name for different types of saving plans or saving funds. One of them is a Tikkun 190, which is also a private investment plan that one could put money into and has some tax advantages. Another one is a Kupat Gemel Hashka'a, which is more flexible. Can be also for shorter term. It's another savings plan that you could put money into, but you could take out money at any time. And it has the option to keep it until retirement and then take it out as a monthly stipend as part of your pension without paying taxes or capital gain taxes. So these are other investment products that you have available in Israel. Now, U.S. citizens should just be aware that these products, Kupat Gemel, private Kupat Gemel, uh, are problematic for Americans uh, because of PFIC issues. We will discuss that further later on, but that is something just to be aware of. Okay, another savings plan that is available in Israel. So there is this government plan that's called Chisachon LeKol Yeled. It's a child savings plan, which started a couple of years ago. The government puts aside each month. Right now, it's 57 shekels a month into this investment account for each kid in Israel under age of 18. So from when a child is born or from when they make aliyah until they turn 18, the government puts 57 shekels a month into this fund. And the parents have the option to match that deposit, to double it. So they could have another 57 shekels deposited each month into this fund. And that comes off actually from the kids' allowance, the Kitzbat Yeladim that parents receive. So that 57 shekels will come off of that. This money goes into an investment fund that's invested for the kid. And you can also choose the same way you can choose for Keren Hishtalmut and for your pension. You could also choose the investment track for your child. And once the kid reaches, I think it's at age 3, they get another bonus of like 280 shekels or so. And then at bar mitzvah or bat mitzvah for a girl, another 280 shekels. And then they can take it out technically at age 18 if they want. But if they keep it there until age 21, then they get another like 500 shekels bonus. Now, during this time, till age 21, the government pays the management fees. So there are no management fees on this fund. And this is another investment option that is available in Israel and is invested in also in the market. So you can make a decision of where this money will be invested, and that decision can make a big difference in the long term. The default, if you don't choose, it used to be that it goes into a bank deposit. So the bank pays whatever 2% at that time. Now it's a little bit more, but that's a very low rate of return. They switched it recently that the default is a medium risk investment plan. So it's invested in stocks and bonds of medium risk. And you have the option to choose to put it at a higher risk and earn higher returns in the long term. So that is another decision that you can make to improve your returns or your child's return over time. Okay, so these are the different types of savings that are part of the Israeli financial system and the employee benefits that are available. What considerations should you take into account when you decide on these products? So one consideration is the costs. The fees that you are paying for these funds. So for pension, you have the management fees, and so too for Keren Hishtalmut, and you want to make sure that you're not paying high fees. So that could make a big difference also over time, because if you're paying, let's say, just another 0.5%, we saw how over time that 0.5% could make a big difference. Okay, another thing to look out for is the insurance. So the pension funds have insurance products built into them. There are different types of insurance. There's life insurance and disability insurance. You want to make sure that you have the right insurance coverage and you're not undercovered or overcovered. That these are more another consideration to take into account. Taxes. So we mentioned the Keren Hishtalmut, which has tremendous tax advantages. Some of the products also have tax advantages, so you want to make sure you are taking advantage of those tax benefits. The risk profile, or the Maslul Hashka'a, the investment track. So as we discussed, you can choose the investment track of these products, and if you are investing at a young age and you have a long time until retirement, or for your child savings plan, right? If your child is young and they have, many years until they turn 21, then you could choose a higher risk profile, or higher risk investment track, so that the money could grow more over time. And we saw how, again, the higher returns, even 1% or 2% more per year, could make a tremendous difference over time. So let me just give you an example, okay? Let's just take someone who is making an average salary in Israel is somewhere around 40,000 shekels. Usually, Olim make much more than that. They have higher education, and they work usually in sectors that make more money. But let's say even someone who's just making 15,000 shekels a month. Okay, so let's say they start working at age 30. That means that they're putting each month they're putting, or the employer together with the employer, they're putting aside over a little over 3,000 shekels a month. Let's call it 3,000 shekels a month that's going into their pension fund. So from age 30 until age, let's say 65 for a woman, okay? A woman is retirement age in Israel right now is at 65, for men it's 67. So someone is putting 3,000 shekels a month into their pension each month from age 30 till age 35, 65, that's 35 years. That 3,000 shekels, if they're investing at 5% rate of return, which is usually would be like a medium risk level, medium investment track, would make an average of around 5%. So that will turn after 35%, after 35 years, will turn into around 1,300,000 shekels after 35 years. Okay, maybe a little bit more, close to 1.5 million. But if you invest it at higher risk and you manage to get, instead of 5%, you manage to get 7%, that 2% a year that you're making more will result in double the amount you have at retirement. So instead of close to 1.5 million, you'll have closer to 3 million shekels. So that is a major difference that one little decision can make over time. Okay, now another advantage that there is in this way of investing by adding money, a certain amount each month to your pension or to your Hishtalmut, is the dollar cost averaging. Dollar cost averaging means that you are adding money each month and buying into the market every month. So with the example of the pension, you are adding 3,000 shekels each month into your pension, and that is being invested in the market. So you are buying no matter what the market is doing. The market is up, the market is down. You are buying, you're adding 3,000 shekels a month into the market. So what that creates, that basically averages the cost of the investment, because every month you're buying. So if the market is going down, then you're continuing to buy at lower prices. So that reduces the risk of the volatility of the market. Because even if the market goes down, and even if it goes down a lot in certain years, you're continuing to buy the dip and buying at lower prices. And then when the market goes back up again, like it usually does, then you earn from that rally correction in the market. So dollar cost averaging is another major advantage of investing this way. And it doesn't have to be with pensions or with Ishtalmut, which is the way it's built into these products are built. But you can also do it yourself with your own investment plan. If you set up an investment plan with adding monthly amounts each month, that creates the same way of dollar cost averaging and buying into the markets and reducing the risk. Okay, now the actual returns, you want to make sure that you are looking at the actual returns of these products. So when you're looking into the Keren Hishtalmut and the pension and the Kupat Gemel or the Chisachon LeKol Yeled, you could look at the government website that's called GemelNet that has all the information about the returns of the different funds and the different investment tracks. So you can look what they've done over time, and that will help you make a better decision. Okay, let's see. Let's just look at the chat. Let's just see if there's any questions. Okay. What if you start investing at 40? Okay, so it's never too late to invest. The earlier you start, the better. But also at age 40, if you start now, rather than waiting, you'll have more time to enjoy the power of compounding. So it's never too late to invest. And even when you're starting at age 40, if you're saving for retirement, you still have plenty of time, or whatever reason you're saving for, it's never too late to start. Okay, can someone open a Keren Hishtalmut on their own, or only if their company offers it? Are employees required to offer that? Employers required to offer that, or only specific sector? No. So if you are employed, the only way you can open a Keren Hishtalmut is only if your employer offers that. You could negotiate that, and I think you should negotiate that with your employer. Not all employers will agree to that, but that is definitely something that you should try to negotiate if they don't offer it themselves. But if you're employed, it can only come from your employer. If you are self-employed, then you can open up the Keren Hishtalmut yourself. You don't need your employer to open it for you. Okay. What other question over here? Who chooses percentage, 5 or 7% regarding pensions, medium risk? So the 5 or 7% I just use as an average. medium risk averages, I would say maybe 5 to 6%. Five is a little conservative uh, rate of return. But if the default is usually medium risk, if you don't choose actively your investment track in pension or Hishtalmut or the Chisachon LeKol Yeled, the child savings plan, then it will be invested at medium risk with an average rate of return of around 5.5%. If you choose, and you can actively choose the investment track. So if it's with your pension, either speak to your pension company, the usually the insurance companies or the investment houses that are managing your fund, or the same with Keren Hishtalmut. You can ask them to switch the investment track to higher risk if you have enough time till retirement or till you're planning to use the money. So with retirement, you have no choice. You can't touch the money until you reach retirement. So if you have at least 10 years or more until retirement, then it would make sense for you to probably be at higher risk because you have enough time for the money to grow. And with Keren Hishtalmut, so it depends when you're planning to use the money, because technically after 6 years you could withdraw the money. But if you plan to keep the money invested and not touch it for longer than that, then you could consider also investing at a higher risk and earn higher returns on average. Okay, let's continue. Okay. Okay, so we discussed this asset management in Israel. The Israeli stock market, also called the TASE, Tel Aviv Stock Exchange, um, is a very developed stock market and bond market. The bonds here are very easy to buy and sell, unlike in other countries. The Israeli stock companies, the Israeli publicly traded stocks are mostly traded in the Israeli Stock Exchange. Some of the companies, especially the technology companies, are actually traded on the NASDAQ exchange in the US. The returns of the Israeli stock market is very comparable to the Western markets. We'll go over that soon. We'll show you some examples. Real estate, we spoke about real estate in Israel. In Israel, it's a very common investment. People like to buy real estate. Usually they do it through buying an apartment, investing in an apartment. And Israel also has a very strong high-tech and biotech startup sector. Okay, so the Tel Aviv Stock Exchange, the capital markets in Israel. There are different ways you can invest in the Israeli stock market. You can either do it through your bank. Through your Israeli bank, you have the option to uh, log in. If you have already an Israeli account, you will see there's a section that's called the capital markets, or Shuk Hon in Hebrew. You can simply log in. You might need to just ask the bank to give you permission to buy securities, and then you could just buy securities through your bank account. That's very convenient. Usually the banks charge higher fees. So they charge transaction fees and custodial fees, which can typically be around 0.5% a year. So these fees are higher than the alternative, which is opening an investment account through the investment houses in Israel. So the private investment houses also enable you to open a brokerage account, and you can buy same type of securities through the investment account and pay lower fees. Now, you can either invest your money in Israel Well, one option is doing it yourself. Another option is have someone, a professional, manage the money for you. So that would be portfolio management or Menalei Tikim in Hebrew. Uh, that's one of the services that we offer. We manage uh, money for people, portfolios for people in Israel and in the US. So the client gives a limited power of attorney to the investment manager, to the portfolio manager to manage their account for them. And you can also use a Yoetz Hashkaot, investment advisor through the bank. So the bank also offers investment advice service, and they could help you invest your money, but their service is different type of service. They're not authorized to manage your money themselves. They could just advise you, and they need to get your permission for every single trade. So they will need to call you up and tell you, okay, I think you can do this. I think you should do this, and they'll need you to sign and approve every single trade. So that is done in a different way. That is through the banks. Okay. Now the banks also offer saving plans and bank deposits. So you could put money in a bank deposit, which will usually earn you lower returns, and you will need to lock up the money for certain periods of time, usually a year at least, in order to get a reasonable rate of return. The other investment class is bonds, which we mentioned earlier, stocks, foreign currency. So we will discuss that more in the next couple of slides, but you want to make sure that your investments are not exposed too much to foreign currency if you are living in Israel and you're spending in shekels. So if your investments are mostly in foreign currency, in dollars or in pounds or in euros, then you are exposed to the fluctuation of the exchange rate. So that's an additional risk that you are exposed to, and you would ideally try to minimize that risk and not have all your investments in foreign currency. Okay. Now, the different financial instruments that you can use to invest the money. One is a mutual fund. So a mutual fund, which is a Keren Hishtalmut in Hebrew, is basically a fund that it's like a basket that has in it many different stocks, or could also be bonds. So you could buy one unit of a mutual fund, and the managers of the fund, they go ahead and they invest the money in different stocks. So they usually, with mutual funds, they usually manage the money in an active way. So they go ahead and they try to select different stocks that will do better than the market and the general market. And they charge management fees. Usually mutual funds charge higher fees. So that is one instrument that you can use to invest in the market. Another way to invest is through ETFs, exchange traded funds. In Hebrew, it's Karanot Sal, which is a similar idea to mutual funds. It's basically a fund that also includes many stocks in it. So it's like a basket that has many stocks in it. And by buying one unit, you get exposure to the entire index that the fund is investing in. So the ETFs generally invest in broad indexes. So such as the S&P 500 is one of the most popular index in the world. That is the 500 largest companies in the US stock market. that index tracks the performance of these 500 companies. So there are ETFs that track the index, the S&P 500 index. So by buying into this fund, this ETF, you get exposure to the entire index. Okay, and there are different types of indexes. There's, different markets like the US and international and Israel, and there are different sectors like the technology sector and finance and energy, and there are many different ETFs out there. Hedge funds is a more sophisticated type of investment, not really relevant to most people, and will not elaborate on that. Okay, so this is an example, a chart that shows the returns of the Israeli Tel Aviv 125 index. The Tel Aviv 125 index is the parallel to the S&P 500 in the US. So in the US, the S&P 500 index tracks the 500 largest stocks in the US market. And in Israel, we have the Tel Aviv 125 index, which tracks the 125 largest stocks in the Israeli Tel Aviv stock market. So that includes all the large banks in Israel and the insurance companies and real estate and technology. And that basically covers the Israeli stock market and a lot of the Israeli economy. So if you want to invest in Israel and invest in a wide, diversified index, then you can do that through the Tel Aviv 125. So this chart compares the returns over from 2017 until 2025, the returns of the Israeli Tel Aviv 125, which is the blue chart, the blue graph, and then in purple is the S&P 500, and in red is the Nasdaq index. The Nasdaq is the U.S. technology index, which includes the major technology companies, all the large mega tech companies like Apple and Google and Amazon and Facebook and Microsoft. So the Nasdaq 100 includes the top 100 technology companies. The technology sector has done very well in the last decade or so. You can see over here in the chart. But if we look at the Israeli Tel Aviv 125 index compared to the S&P 500, you can see that even though at certain periods the S&P 500 did much better, but overall, over this period of time, and they're almost the same. So the returns of the Tel Aviv 125 index are very comparable to the S&P 500, and it's been one of the best performing markets in the world. Okay, in this chart you could see also the comparison of the Tel Aviv 125 to the S&P 500 over the last 5 years. So we saw before from 2017 over the last 8 years. Over here you can see the past 5 years, and in fact the Israeli stock market outperformed the S&P 500, the US market, by over 25%. So this is, just an example how the Israeli Tel Aviv stock market performs very well at certain times and even better than the S&P 500. You can see in the chart the past year and a half, there was the big jump in the Israeli stock market after the successful operation with Iran and the war. So the Israeli stock market managed to recover from the poor performance that was beforehand. Okay, now in addition to the Israeli stock market performance, which we saw that is uh, at certain points even better than the U.S. stock market, we also need to take into account the dollar rate, which we mentioned before, the currency risk. So this is the dollar to shekel rate in the past 10 years. So this chart shows you the change in the exchange rate, and it went down 15% in the past 10 years. So on top of the stock market performance, you also need to take into account the change in the exchange rate. So even if let's say the US market did better than the Israeli market in, percentage wise, but in terms of the value for you in shekels, it could be that you ended up losing money or making less than you would make in the Israeli market because of the exchange rate. So 15% drop in 10 years is quite a bit, and you can see that certain periods the drop is even larger than that. So that is another reason why you want to have some of your money invested in Israel and in shekels in the currency that you're spending in, and avoid the extra risk of the exposure to foreign currency. Okay, now I just want to point out that I'm not saying that now you should move all your money from the US and invest in Israel. Um, that's not what I'm saying. Israel, after all, is a small market compared to the rest of the world. It has a very strong economy, and the stock market is doing very well, and the shekel is one of the strongest currencies in the world. But what I'm trying to show you is that the Israeli stock market does offer great returns, and the shekel is one of the strongest currencies, and you should consider moving some of your money to Israel and protect yourself from the currency fluctuation. Okay, let's just look at the chat again for some questions. Israeli stock market did better before or after Iran war. So it actually did well even before the war with Iran, but especially afterwards, in June of this year, the Israeli market, after the successful war with Iran, jumped even more. It did well before, also in 2024, also in 2025, till the war with Iran, but especially since then, the shekel and the Israeli stock market jumped up. Okay, what happens if you have a Keren Hishtalmut and switch companies where it's no longer offered? So if you have a Keren Hishtalmut, the money is yours. It stays yours, even if you move to a different job that doesn't offer Keren Hishtalmut and you stop adding to it, that money still stays yours and it grows, and you can take it out after 6 years passed since you opened it. So yeah, you get to keep it, and we're just not adding money to it. Okay, so this chart just goes over the advantages and disadvantages of investing in Israel versus abroad. So we went over most of this already. Maybe one point over here that is important. Another advantage to having your money locally is the access is much easier when you're local. So sometimes when people have money in a foreign country and they're living here, the institutions make it harder and harder to take out money or to move money out without coming in, especially if it's large sums. So sometimes people need even to fly in and go to their investment company or bank to move money. When you are local and your money is here, then that makes it much easier to handle and to access it. Um, okay, taxation. Okay, we'll speak more about taxes soon. Just to mention inheritance tax. So Israel does not have inheritance tax. So if you're investing in Israel, you have no exposure to inheritance tax in Israel. Okay. If you are investing in the US and you are not a US citizen, then you are exposed to inheritance tax of if you have above 60 or $70,000 or so in US based assets, then you are exposed um, to tax in the US. Let's see anything else here. Okay, financing in Israel. People don't usually leverage much or finance investments. They usually do it with apartment, with real estate. They finance uh, using a mortgage, but not so much with other investments. In the US and maybe in other countries, it's more common. Bureaucracy in Israel is usually more complicated than the US and some other Western countries, depending on the country. Currency risk we discussed, diversification. Okay. Okay. So let's discuss a little bit of tax implications. Okay. So if you are a US citizen, then you are required to report your taxes even if you live abroad, even if you live in Israel in this case. So that includes the annual tax return that you need to file, which I'm sure you have or had already another class on that. But when it comes to your investments, you need to file an FBAR report, which is a foreign bank account report. If you have more than $10,000 in your accounts, then you need to file a report for each account. Also, if you're American, you need to be aware of PFIC, Passive Foreign Investment Company, which is basically any product that is structured as a foreign passive foreign company, which includes mutual funds or ETFs, exchange traded funds, many of the private investment policies or Kupat Gemel that we mentioned are also considered PFIC, and they are taxed at a much higher tax level. They're taxed like ordinary income instead of capital gain uh, taxes, which is higher, the ordinary income usually. It's at the marginal rate, so it's going to be at the higher rate. And you also need to file special report each year, and you need to pay taxes every single year, even on unrealized gains. Usually, you pay taxes when you sell your investment at a profit. So that could be, if you hold it for many years, you could not pay taxes for 20, 30 years. But with something that is considered a PFIC, you need to pay the taxes every single year, which also makes it not profitable, and US citizens should avoid anything that's a PFIC. Okay, dual taxation. As a US citizen, you might be exposed to double taxation in certain cases with certain investments that might be classified in different ways in the US and in Israel. So you need to make sure that your investments here and in the US are aligned with the tax rules, and should consult with your accountant to make sure that you're not exposed to double taxation. The 10-year tax holiday for Olim is a major tax advantage for Olim. you don't need to pay or report taxes in Israel for the first 10 years of Aliyah on investments from abroad or income from abroad if you made that income when you were abroad or when you go abroad, not if you're working from Israel for an American company, then you still need to pay taxes. But if you're working in America or you have investments abroad, you don't pay any taxes in Israel. So as a US citizen, it's still an advantage because the taxes in the US are generally lower. The capital gain taxes are generally lower than in Israel. And for non-US citizens, it could be an even bigger advantage if they don't need to pay taxes in their country of origin and they don't bring the money here. So they move the money to a third country and then they might not need to pay taxes in Israel or in their original country, and they could potentially save a lot of money in taxes. Okay, now in Israel, there's no reporting requirement unless you are self-employed or you have a company. But if you are employed, you don't need to report your taxes. Taxes are taken out at source in Israel. So that's regarding your regular income, ordinary income. With regards to your investment income, that's also taken out at source. So if you're investing through an Israeli investment account through your bank or through a private brokerage account, then you don't need to pay taxes proactively. It's taken out at source and you don't need to report your income and your profits. In certain cases, you might want to report if you want to get back taxes, if you donated money, or if you have certain tax benefits that you need to take advantage of, you might want to file a report, but you don't have to file a report like in the US. Okay, so if you want to make sure that you're invested successfully, you need to make sure that you're taking into account your taxation. Like we discussed, if you are a US citizen and you're investing abroad, or if you in a different country, if you take advantage of the 10-year holiday, just want to make sure that you are maximizing your tax benefits and your options because that can make a very big difference. Rebalancing when you have your money invested originally, if you set it up in a way that is aligned with your goals. So if you decided you want to invest, let's say 50% in stocks and 50% in bonds, and then after a while, the stocks went up more, which usually happens over time, then it could be that right now the stocks went up to 70% of your portfolio. And you might want to rebalance that, make sure to sell some of the stocks and add more to the bonds so it goes back to the way you initially wanted it to be. You don't need to do that too often, but once a year or twice a year to look at it and see if it needs to be rebalanced. An exit strategy. When you enter an investment, you want to make sure you know how you are planning to exit. So with financial assets, it's much easier to technically sell the investment because it's traded on stock exchange and it's very easy to sell it, the stocks or the bonds. But with other assets like real estate or other private investments, it's not always so easy to sell, and you need to have a plan of how to exit the investment and make sure that you can get out at the right time for you. Liquidity, you want to take into account your liquidity. Same idea with financial assets. You have usually full liquidity. With real estate and other investments, you don't have as much liquidity. So you need to make sure that your liquidity requirements are also fulfilled. Okay, and contrarian investing uh, basically means that you want to stick to your plan and not follow different trends and the hot stock of the month and run after different trends. What usually happens with such trends, you enter at the peak when it's already inflated and you end up selling low when things went back down. So you just got to stick to the plan and stay with your diversified fund and not try to chase any trends. Okay, let's just take a few minutes to discuss investment fraud. Unfortunately, this is a major problem. We've seen many investors that lost a lot of money in different investments that they didn't look into properly and didn't do proper due diligence. So let's just go over a few key points over here. Never judge a book by its cover. If people go to extreme means to look reliable and trustworthy, should always be careful, and you should always look beyond and look at make your own, do your own due diligence, and don't trust anyone, and don't be impressed by the impression that they're trying to make. And of course, don't trust anyone just because you know them or someone recommended them. You should always do your own due diligence. There are many cases that the people that they know, they invested with them, and unfortunately, they lost a lot of money, or people that recommended someone, but they themselves didn't really look into it properly. You should never trust based on other people's recommendation. You should always do your own due diligence and make sure uh, that the investment is a legitimate investment. Low risk or guarantees of gains is a telltale sign. If someone promises you that this investment has low risk, very low risk, or they have guaranteed gains. We guarantee you're going to make 12%, you're going to make 14%, any guaranteed gain. Okay, maybe besides a bank deposit that's guaranteeing you 4%. But any investment out there that someone's trying to market to you and is guaranteeing you a certain return, there's no such thing guaranteed return. If someone's guaranteeing return, that is usually a huge red flag because no one knows, there's always risk and no one knows what's going to end up being with a investment. So nothing is guaranteed. There might be a potential, there might be a good opportunity over here, but if someone tells you that there's a guaranteed high return, or it tells you this is a high return investment with low risk or no risk, that is a red flag and that's a sign to stay away. Okay, be careful of those with secrets or inside info. People are trying to market you an investment in a way that, this is a unique opportunity that only they have this insight of this information. That is also something to stay away from. Okay, be careful of sophisticated investments marketed to the general public. So if someone the public comes to you with a very sophisticated investment option, and he's telling you, this is a one-of-a-kind investment and has huge potential, very special deal just for you, then why is he coming to the to you? Why is he coming just to the simple person? There are funds out there and investment managers over there with lots of money that are willing to put a lot of money into good deals. If this deal is a really good deal, then he doesn't need to chase after small investors with, a few tens of thousands of dollars or so. They could go and get millions from the big investors out there. If they're running after small investors, that means that they have something to hide that the big investors are not willing to give them the money, and there's probably a reason for that. So you got to be careful uh, with that. Okay, offshore. So if investments are registered offshore, which means usually in a country that doesn't have any taxes on foreign investments. Uh, these are different. Um, used to be tax havens that don't really exist anymore because the transparency in the financial world uh, just got greater over the past few decades, and it's very hard nowadays to hide investments in countries that don't charge you taxes. But these offshore countries, like the Cayman Islands and the Virgin Islands, uh, they generally don't charge taxes on foreign investors. So people usually put money there or investment managers or funds. They register their investment there to avoid or to save taxes. You got to be careful uh, with such registrations, whether if you're doing it personally or the fund that you're investing in is registered in such a place. It could be very difficult to bring money over from these places to Israel or to the US or any Western country. The governments and the financial assets, the institutions have very strict rules of bringing money over, and it's becoming harder and harder to do that. So you got to look into that very carefully. Okay, now you also want to make sure that you know where the marketers are making their money, how they're being compensated. If someone is marketing to you an investment and doesn't tell you how they're being compensated, then that's also a bad sign. You want to know how they're making the money, and there should be transparency so you know what is their interest and how they're getting it. So you have that information and you can make a better decision based on that. Okay, now if you have certain questions that you're asking to the salesperson, you made due diligence and you start to ask questions, and you see by their reaction if they start getting upset or uncomfortable and trying to avoid answering the questions, that is also a bad sign, and you should stay away from that. If they are open and they are answering your questions and they're comfortable with that, then that shows they don't have what to hide. Okay, and different sales tactics that they have, trying to be either too warm or excessively cold. Don't fall for these tactics. They are just trying to sell to you, and uh, try to stay away from that. Or if they pressure you to sign immediately, this is an opportunity that you can either sign now or it's going to be gone. Don't be pressured by that and don't fall for these tactics. These are uh, sales tactics that they try to get you to fall into, and you should stay away from that. Okay. Um, the four questions that you must ask prior to making any investment. So the first question is, how can I lose money with the investment? Okay, so we discussed the upside, the returns over time, how returns can make a difference, but it's very, very important to also look at the negative side of the option or the potential of loss, because there's always potential of loss with any investment. There's no such thing in investment without risk, and every investment has risk. So you need to ask yourself, how can I lose money from this investment, and not only look at how you can make money. It's very easy to look at the the optimistic side, but you also need to look at the other side of the coin and see how you can lose money, identify the risk, and try to reduce the risk by spreading the investment, by diversifying into different investments, into different currencies, into different markets. That is the first question. Also, second question, how realistic is the expected return? Don't be too excited by the potential returns and too optimistic. Look at the realistic expected returns. What could be the expected return? Take into account all the costs, like we discussed, the fees that are involved in the investment, the taxes, and take into account the realistic returns. Okay, what is my exit strategy? We discussed that. Make sure you have liquidity. Make sure you can get out easily whenever you need. How does this investment make good business sense? Use your common sense. At the end of the day, when you're investing money in a stock, you're investing in a business, you're investing in real estate, you're also investing in a property. It needs to make sense. Just use your common sense, whether if it's the stock, look at the company, what they're doing, look into the field that they're working in, look at the product of the company, understand what the company is doing. Don't invest in something that you don't understand. Okay. Now let's just see if there's any questions before we continue. No. Okay. So let's continue. Let's just take a few minutes to discuss the option of investing yourself, doing it yourself versus using a professional manager to manage it for you. Okay, so let's just go over the pros and cons of doing it yourself. So investing yourself, the first pro is learn more and gain expertise. So when you're doing it yourself, you need to do your due diligence. You need to find out more about the company, about the market that you're investing in, about the way you could invest, the currencies, all that gives you more experience and you learn more from the process. It also keeps costs lower. So you don't need to pay the fees to the manager, but you also need to take into account that when you're doing it yourself, if you're doing it through the banks, then you generally would pay a higher fee to the bank, while with an investment manager, portfolio manager, they many times manage to negotiate lower fees with the banks. Another advantage of doing it yourself is lowering the risk of investment fraud. You're not handing the money to someone else. So with stocks or financial assets, there's not much room for fraud. You're buying a publicly traded security through a stock exchange. So that doesn't matter so much if you're doing it yourself or through a manager. But if you're handing your money to someone, if it's a private investment, it's a hedge fund or a different type of private equity fund. So there you have the risk of fraud, and when you're doing it yourself, you have less risk of fraud. Another advantage is feeling that you can outperform and focus investment better. So in certain cases, some people manage to select their own stocks and their own investments and do better than the market, the general index like the Tel Aviv 125 or the S&P 500. It's very hard to over time consistently beat the market. So that's not something that we usually recommend for people to do, but certain people manage to do that maybe at certain times. and that might be an advantage also. And another part, which is the more psychological uh, advantage, which is the fun and the excitement. Some people love the fun and the excitement of investing themselves. It feels like, like a casino, like you're gambling and you're buying the stock that you think it will go up more. That is another advantage that might cause some people to want to do it themselves. Okay, now on the flip side, what are the disadvantages? So the first one is the difficult to beat the market. Uh, Most investors underperform the market over time, and it's very hard to beat the market. So if you're trying to do it yourself by picking your own stocks, then you are very likely to fail to beat the market. This another disadvantage is the time that it takes you to do it yourself. If you are putting a lot of time into research and following, could take a lot of your time, and that could be extensive. So that is another major disadvantage. Another one is the lack of experience or knowledge for you to manage your own money and to diversify. Uh, Many people don't have the knowledge and the expertise, and that's why they want to hire someone to do that for them, to outsource it. It could also cause stress if you're doing it yourself. You're constantly looking at it, you're seeing going up and down, and that could cause stress, which for some people that might not be a good thing. And the lack of interest. Sometimes people just don't have so much interest anymore in managing their money, and they're not going to overlook it and take care of it of their portfolio. Um, and if they pay someone to do it, so they're going to always be on top of it and do their job. Now, on the other side, versus hiring a manager, so the advantages of hiring a manager, outperforming, outsourcing to a professional. So you're not doing it yourself. You're paying a professional who knows what he's doing. That's the job. Uh, you're paying just like you would outsource many other things that you can maybe learn how to do yourself, but you'd rather give a professional who knows what to do it. You could pick multiple professionals to diversify. You could put your money in different funds or different professionals, have them manage it. It saves you time, a lot of time. If you need to uh, look into the investments and take the time to overlook and to rebalance and to make adjustments, that could take a lot of time. By paying someone, you save that time. Another advantage is improved long-term gains. So improving long-term gains doesn't necessarily mean that you will do better than the market. In fact, many managers, or even most managers, I would say, they fail to outperform the market. But what one of the main advantages the professional has is preventing you from making mistakes. So, for instance, in COVID, in March and April of 2020, when the market dropped by 30% in 2, 3 weeks, many people panicked, and people who have their own portfolio might sell or sold their portfolio, got out of the market when it was down. What happened afterwards? The next couple of months, the market shot back up again and actually ended up the year at a much higher return than before the corona. So that is a mistake that could cost you a lot of money. And when you have a professional with us, for example, clients panicked and that makes sense. Market dropped, and people called, what should we do? What should we do? Should we sell? Should we sell? And we told them, don't sell, just wait, be patient, wait for the market to go back up again. And that's really what happened. So the professional could help you and prevent you from making mistakes, which could cost you a lot of money. And it reduces your stress. You don't need to take care of it. You have someone looking over your account and managing it for you. That is another advantage. And the cons of hiring a manager is if the manager doesn't perform well, if he outperforms the market. Um, Now, in general, I would say for young people who feel comfortable with doing it themselves just by putting money into a diversified fund, then for them, it in many cases just makes sense for them to do it themselves. They don't need to pay someone to do it for them. If they know they're investing long term, they feel comfortable investing in high risk, put it in a diversified ETF, then there's no need to pay a professional. But people that don't feel comfortable, they're afraid of making mistakes and selling at the wrong time, or if they have special requirements and investing for shorter term that might need help to put together the right risk profile and invest in bonds and other types of investments, then for them a portfolio manager could really help and earn them more returns than they would do themselves. Okay, risk of investment fraud, we discussed. Costs can be higher. You're paying fee to the manager to manage your money, so that could be higher costs. Lack of understanding how to choose a manager. If you make wrong decision in choosing a manager, um, and the complexity of C structure, lack of transparency, if you're not understanding really what's going on, there's no transparency, you don't understand how the fee is structured, you can end up paying more fees. Sometimes the fees are hidden, the funds that are in the account. So that is another disadvantage that could be with hiring a manager. Okay, and what we like to say is that you can delegate authority, but you can't delegate responsibility. So it's after all your responsibility, and you need to make sure that your account uh, is doing well and placed well. Okay, so this is our book that Baruch Levinsky wrote, A Financial Guide to Aliyah and Life in Israel. This does cover a lot of what we discussed and the investments in Israel and the investment products and the and the stock market and a lot of the topics that we discussed today. It also goes over many other financial topics related to budgeting and aliyah planning and real estate and other financial topics. We have uploaded it a few years ago online, so you could go over it. There's a digital free copy. You could just go to the link over here, financialguidetoaliyah.com, and go through the book. If you want to contact us, here's the information. You could look at our website at levinsky.com. And if you want to join our newsletter, sign up to our newsletter, you could scan this QR code. We will send you after the meeting the presentation so you can look at the contact info if you want, or just enjoy the presentation.